Hello, welcome to this week's update on the US stock market. I'm Aidan Hogan. First, let's examine the performance of various assets last week. The market continued to move towards recession, with 10-year bond yields weakening and falling below the 200-day moving average and the neckline. At the same time, gold rose above the $2,000 level, while 20-year treasuries continued to rise. Defensive sectors such as healthcare and consumer goods, represented by the XLV/XLPA, have remained strong for several days. In addition, signs of a recession continue to appear in the fundamentals. The latest ISM manufacturing PMI data fell to a 3-year low, and the ADP jobs report for March showed a decrease of 145,000 jobs, below the expected 200,000. Furthermore, the non-farm payroll data released on Friday showed a change of 236,000 jobs, below the expected 239,000, and the first time it has fallen below expectations in 11 months. Over the weekend, unexpected news of OPEC's production cuts boosted oil prices back up to $80, and they have remained stable for several days. Some predictions suggest that prices could even rise above $100, but the technical chart has not yet broken the 200-day moving average. Currently, the stock market is being affected by both a recession and stagflation, which is a challenging combination. Stagflation refers to a situation where inflation is high, but economic growth is low. In this case, persistently high energy prices are the main cause of inflation. The last time the US experienced stagflation was in the 1970s, when the economy was facing a recession and an oil crisis, making it even more difficult to manage. In such a dire environment, the prospect of a recession should weaken a company's profitability. But why has the stock market been rebounding since mid-March? And why has the pan-European index Euro Stoxx 50 even rebounded to near historic highs after the bank crisis? Here are some possible reasons. The Fed is reversing its quantitative tightening QT policy, and the liquidity released through the Bank Term Funding Program (BTFP) has offset the impact of the Fed's balance sheet reduction in recent months. The Fed may continue to release liquidity over the next year. Although the prospect of a recession may harm corporate profitability, the disruptive changes brought about by AI may allow companies to significantly reduce costs and improve profitability, offsetting the impact of the recession. The stocks of technology giants, which are the most capable of implementing AI and changing the way of life, are the main driving force behind the current stock market rally. The stock market has always moved in the opposite direction of the collective consensus. In mid-March, most people were bearish. However, if this were the only reason, the stock market would fall again when most people's views begin to reverse. The latest AAI sentiment shows a significant increase in bullish sentiment and a noticeable decrease in bearish sentiment. Despite the recent strong upward trend in the stock market, there are indications of concern regarding its breadth. Several growth leaders that recently broke out have experienced sharp pullbacks in the past week, with many falling below their breakout points. Examples of such stocks include MELI, FSLY, SPSC, PANWI, PD, FOUR, SMCI, HGB, SA, and MHOI. The market breadth ratio remains weak, and the percentage of stocks in the S&P 500 and Nasdaq above their 50-day and 200-day moving averages is significantly lower than normal, contradicting the overall trend. Moreover, the number of stocks reaching 52-week highs, 74 stock, is much smaller than the number reaching 52-week lows, 208 stock. The market has been driven mainly by mega-cap stocks, such as APL MSFD, GOOGL, MATA, NADEA, and RICL, with little success in broadening the market. In summary, the current market condition appears to be unhealthy. If the weak market breadth persists, the upward trend may not be sustainable. Regarding my personal investment strategy, I have received warning signals such as a market recession, defensive stocks becoming stronger, leading stocks pulling back suddenly, market breadth, and significant divergence between IWM and SPX that require me to be cautious and avoid opening new positions in stocks. I prioritize defense until signs of market improvement appear. Based on a buy signal analysis, the NASDAQ signaled a buy on March 16th, and the stocks that broke out within 5 trading days afterward performed well, including FDNT, LNTH, DSGX, AGIH, AUZI, LVMUI, and others. However, most stocks that broke out after the March 31 index breakout experienced a sharp drop below the breakout point, such as MELIP, IUWHU, BSEA MHO, MNTHA, and others. This suggests that the current success rate of market breakouts is low, and we may be in a trendless market, a weak uptrend market, for some time. Regarding tech stocks, I plan to maintain my current positions in the following: SMCI, already at breakeven, with additional purchase on April 3 having already been stopped out. I will keep the remaining position with a sell stop at $93.90. FDNT sold half of position, with profit holding the remaining half with a sell stop at $60.50. STM sold half of position, with profit holding the remaining half with a sell stop at $49.20 and $47.80. As for defensive positions, I currently hold the following: UGL2X ATF for gold. After a breakout, a normal price behavior would be a pullback with reduced volume. I anticipate it to remain above the 10-day moving average, or $63 previous high, to indicate the next round of upward momentum. I have already protected break-even profits with my stop at $60.70. A GI gold mining stock, it has demonstrated strong momentum with a weekly chart forming a large cup with handle pattern. I will retain my position as long as it does not fall below the 10-day moving average. TLT long-term bond ETF. I purchased it on March 24, and as more recession worries emerge, the trend is beginning to show progress. If it successfully breaks through the $109 resistance, an uptrend opportunity may arise. Japanese yen. I'm observing for stabilization above the 50-day moving average and waiting to see if resistance can be broken. My position is already at breakeven. Bitcoin BTC, it continues to develop in a box consolidation pattern between $26–$29, with a recent emergence of a wedge-up pattern. $25 will serve as an important support level in the event of a pullback. Ethereum ATH, its short-term trend outperforms BTCE with a breakout on higher volume, followed by a pullback to consolidate near the top of the range. Macro-technical chart patterns. Although there have been many unfavorable signals in the short-term market, opening new positions in the short term may put one at a disadvantage. However, looking at the weekly chart, many stock indices, funds have reversed and risen above the 30-week moving average, with support after retesting. From this perspective, the medium-term outlook may not be as bleak as it seems. Stay optimistic and wait for signals to take action. Because even if there is a true reversal, buying at the wrong time or when the price has already risen too much can lead to losses. Highlight set up a watch list for this week's stocks. LNTHERS 97 Group Rank Top 20 is a true market leader. TML Quality Stock 100% growth. Strong industry group. I will keep a close eye on its development and wait for it to pull back closer to the 10-week line. Issue before finding a buying opportunity. NVDA and ORCLA, as mentioned above, are leaders among megacaps, waiting for a pullback to buy. Defensive stocks have recently turned stronger, and some of the healthcare development setups are worth watching for further development. LLYAMRK, GILDISLV Silver ETF, breaking out of the long-term downtrend, waiting for right-side development. Oil stocks, XOMEBPPBR, keep in watch list. Key points for this week's U.S. stocks. CPI data will be announced before the market opens on Wednesday. The Fed meeting minutes will be released Wednesday. Thank you for watching this video. If you enjoyed it and found it helpful, please give it a thumbs up and subscribe to our channel for more content like this. I appreciate your support and look forward to seeing you again in our next video.